Good afternoon, everybody. It is Monday, September 14th. I'm Kirk Spano, and I am glad to be back. I have been under the weather for almost a week, so bad that I actually went and had a COVID test, which I do not have the results for yet. Interestingly, I had all the cold symptoms, but none of the added symptoms that you'd expect from COVID. My temperature never got above 100. I didn't have any exciting bathroom breaks. And for the most part, I've been pretty good, just up and down tired and stuffy, sounding even more nasally than a Wisconsin guy normally sounds. So I'm feeling better today. Still taking a little bit longer than normal old man naps in the afternoons. But I had a lot of time to read since that's about all I could do laying down. So this week, slightly different format with stocks and options. On margin of safety, we'll be putting those together. I'll split them up because of the different subscriptions over at Fundamental Trends. But I want you to be able to take a look at this because the stocks and the options, they really do work together. I told you I'd start the program with a story. So I'm going to tell you a story. Long time ago, I played soccer. And my dad was my coach in, I believe it was the 6th grade. It might have been the 7th grade. And I was probably the best player on the team at the time, if not the best. I was right there with 2 or 3 other guys. And there was a team that we were playing that had a couple of really big dudes. And they were good athletes, good guys too. I knew them later on in life. And one of them tripped me. And he really tripped me hard. He pulverized me. And I got pretty angry. So my dad took me out for a second. He goes, "Are you okay?" I go, "Yeah." He goes, "Now what?" He asked me, "Now what?" I'm like, I don't know. He goes, "Well, we need a goal." It's like, okay. So put me back in. A couple minutes later, I stole the ball way back down in our penalty box. I dribbled the length of the field, made a couple of fake passes, and people kept laying off me. And I was able to dribble all the way to the top of the other penalty box before the same guy who tripped me caught me from behind and he was going to tackle me. And I got off a shot just as he tripped me, and he wiped me out again. No penalty because the ball went in the net. I've always had kind of a chip on my shoulder. I'm only 5'6". That's what it's on. That's what I tell people anyway. Doctor might say a little bit different. My ID says 5'7". And my singles ads back when I was looking for a girlfriend said 5'8". So, they say in the hedge fund industry, they're looking for somebody smart, poor, with a chip on their shoulder. And I think I'm fairly smart. I'm not poor anymore, but I'm not rich. Although seems like we should be on our way there. And that's going to kind of be a point here. That chip on my shoulder, I'm looking at some of the investment letters out there. And there's been a surge of them on Seeking Alpha. A lot of letters, and they're selling. And I'm reading some of these because I take the trials. And I can't believe the shit that's out there. I mean, I go to Investor's Place, and that's shit. And I go to all the other stuff that's on the internet. I mean, it's just shit after shit after shit. And a lot of these folks who are telling me about how this is a secular bull market, about how this bull market is just different than the last time, it just kind of strikes me now that I have 25 years of experience, have made millions of dollars, that they're really full of shit. And I think a lot of people are about to get hurt. And I said this about last December and January, I told everybody there was going to be a big problem. And then in January, I first mentioned COVID. And by February, I was telling people to sell almost everything. And that was a great call. And then we bought gold. We bought gold near the bottom. And that turned out to be a triple for most folks. A double if you wrote the covered calls with a little bit of income. And, we hit a whole bunch of bottom fishing prices. I didn't pound the table to buy them because I know that at margin of safety that most of the folks aren't trading. And I gave into that. And here's what I'm going to tell you right now. Is you need to embrace at least some trading. And I've struggled with what to give in on and what not to give in on. And I've decided not to give in on anything anymore. I'm telling you that you need to trade a little bit more often if you're not trading at all. If you think you're a buy and hold forever investor, then I don't know why you would ever subscribe to any service ever. Just keep on buying, right? There's no point. The only thing that I would tell you is maybe don't reinvest your dividends so that when the shitstorms do come a few times a decade, you have cash to invest. But if you really want to beat the market, and I'm telling you, I know day traders that make 30, 40, 50% every single year. And I know swing traders who do about the same. I will tell you this. Swing trading is harder, but it has potentially bigger upside. The thing that people do with swing trading is they treat it like day trading. They think they're supposed to make a trade every day. No. Swing trading, you might make 1 or 2 or 3 trades per month. Maybe. And that's all right. And that's why I broke off fundamental trends and I created a swing trading service over there for people who want to do the handful of trades every month. Now, the other type of trading is position trading. And this is where you have to understand the different types of trading. It's in the Getting Started articles. You have day trading, which is you could be trading by the minute. You have swing trading, which is a handful of trades that last from weeks to months. And then, and that's usually useful with hedging. And then you have position trading. And those trades will last anywhere from about 6 months to a few years. I think the folks need to really wrap their head around that. So back in the spring, when I didn't pound the table to buy a lot of tech stocks at the bottom, even though we've been talking about it for months at that point, if you had the risk tolerance to do some buying, you did. And I know that a lot of people did. But I also know there's a lot of people who feel like, well, I needed to be told to buy. So I'm going to tell you exactly when to buy and sell every week now in this article. Make it easy. I've already created the plug and play ETFs and stocks. And I get questions. I've already gotten questions about, what about this and what about that? I'm telling you, if it's not on the plug and play this quarter, ignore it. Unless you have spectacular understanding of why you might want to invest in something that's not on the plug and play. Because I spend an entire quarter vetting this list. And I'm going to make a few changes each quarter. We want to have an asset allocation that's in all the best sectors, that avoids the middle of the market, and really avoids the bad parts of the market, and even shorts the bad parts of the market. Right now, I'm shorting oil stocks, and we'll talk about that at the end of the program today. There's not usually a lot of things to short. I've been trading the semiconductors a little bit, just SOXX. I do think that the NVIDIA takeover of ARM from SoftBank should really sound alarm bells to people. These types of transactions often mark the top of a cycle. So when you start to see big waves of M&A, it's because companies are like, we got cheap money, we're having a hard time with growth, we're kind of starting to level off. And that doesn't mean that they're not growing, it just means that they're growing less fast. The change in velocity is what matters. So when the curve is up and bending up, that's awesome. But when the curve is up, starting to bend over, that's not so awesome. And investors hate that. And markets sell off when that happens. And that's the news that we just got on the world economy. All these people who are yelling V-shaped recovery 6 and 8 weeks ago, and I was saying that's not what's going on, this is just a bounce off the bottom, that is exactly what all the economic indicators are proving right now. And I'm going to put out a series of articles. If I can stay awake tonight, I'll do one tonight, that just show that the economic indicators are not positive. This idea that you can tax cut your way to prosperity and bankrupt the country, but so what? It's just so jacked that I don't understand why we've been doing it over and over and over again for 40 years. This all started in the 80s, and it got worse in the early 2000s, and now we're triple timing it now. And yes, there's COVID. But if there wasn't COVID, I want you to reverse engineer something. The market was overvalued, and the Fed had been trickling money in, not really trickling, they had printed $1 trillion from September to February because of the repo market, which had to be bailed out, which means that there were institutions that were insolvent. Nobody's copped to which ones they are. I gave you a couple of ideas. And then COVID hit, and we threw trillions of dollars at the problem, We've essentially let all sorts of companies that didn't have growth and they had debt problems refinance their debt out 3, 4, 5 years, most of them 5 years. So that means we have a whole bunch of zombie companies right now that were using the PPP, right, payroll protection program, to keep people from jumping onto unemployment. The airlines had a special provision in there which expires in 16 days. There are literally over 1 million people on the verge of being laid off. And these aren't waiters and waitresses and people working at hotels. These are small business people actually who are just going out of business. But then people, professionals with higher incomes, they're about to lose their jobs at the airlines. Because American Airlines said 16,000 people they're going to lay off. And you go company to company to company. That's 1,000, it's 1,500, it's 10,000, it's 8,000, it's 7,000. And it adds up quick. So during the month of October, we're probably going to see an extra 1 million to 2 million people hit the unemployment rolls. Let me ask you this. That's kind of a double whammy, isn't it? All right, so we're folding in some Friday stuff here because I didn't do a webinar on Friday. Those folks not only aren't going to be contributing to their 401k plans because they're no longer employed, but the CARES Act allows them to take $100,000 out. And they're going to need that because the $600 extra a week is gone. So there's a lot of people who are going to be cashing in parts of their 401k plans in the fourth quarter. What does that mean for stocks? Well, the money printer goes burr, right? Money printer goes burr. The Fed's got our back. Well, let's think that through. The Federal Reserve balance sheet hasn't increased in 2 months, right? In fact, almost 3 months now. What we saw is a massive rally in August that was due to two things that we found out because it hit the press. Is you had small investors, people who were trading 10 contracts, optional contracts, calls, just dominated the market. And then you had SoftBank pressing the bet and making millions of dollars just pushing this market up and getting everybody to chase. When SoftBank pulled back a little bit, when people started to say, hey, this might be too parabolic and straight up, we got a 7% correction. Now the market on the daily charts is no longer overbought, as I talk about in this article, and people are buying again. And today the market opened up and got high to the high point by the middle of the day and couldn't push it any higher. If this was really a huge rally, why wouldn't it keep going up in the afternoon? Is there not an extra big buyer out there at the moment? Did SoftBank go away? What exactly is going on? I told you about the hedge funds. We're going to get a couple of days this week where the market's up. And I said that we'd get about 3 to 5% rally in the chat rooms. By Friday, there's going to be selling again. Bill Gross warned today, same warning I've been making for weeks, that we're not going to get a big stimulus package here before the election. And people better be aware of that and prepare for it. Well, a Republican senator came out today and said, hey, I don't think there's going to be a deal before the election. Now, that might be posturing just to get the skinny deal done as part of the budget continuing resolution. I think that's probably what ends up happening. There's going to end up going to be a skinny deal as part of the continuing resolution, a $300 a week for unemployed folks. So that means that the maximum payment for somebody who's unemployed is going to be around $700 a week. How does that help somebody who is making over 100 grand? So we need to wrap our heads around what's really truly going on here. And we have economic indicators that have all started to turn back down. All of them. And the ones that are going up slower. There is no V-shaped recovery. And as we've been talking about for months, we're not going to get a full resumption of the economy until there's a vaccine, or so many of us have had this that we end up with the so-called herd immunity. The problem is that that might not exist. When people start to realize that Pfizer is probably full of shit, and Moderna is probably full of shit, and AstraZeneca is probably full of shit, there's going to be problems. Because none of those new technologies are even trying to be a permanent solution for COVID. These are all emergency use vaccines that they're trying to put together. They have short-term benefits for part of the population some of the time. The more traditional vaccines, such as what Merck is putting together, aren't going to be available till next year. I'm going to stick with my prediction that we don't have a mass distributed vaccine until next summer at the earliest. And I think that on the first day of school next year, you're going to have an awful lot of kids getting shots. We'll see. Only thing that I've had wrong is that we shouldn't have hedged so much after the crash. This retrace should have only been about halfway back up, and yet we've set new highs. In my career, the biggest crashes have followed when the Federal Reserve has overdone it and created a liquidity event that they at some point have to walk back. That's what's going on right now. The Federal Reserve has pumped in a lot of excess liquidity, and now the battle, the long war between deflation and inflation is going to come to a head. There is no growth because there is no vaccine. There's a rebound and it's slowing. Slow growth forever, which is from massive debt and technology, but mainly from demographics, is going to be around for the next 20, 30 years. If you haven't read the Slow Growth Forever article from 4 years ago, tell me that it's not spot on. So the long-term threat of deflation is being met with inflationary policy. And they're blasting monetary inflation policy into a problem that's organic and secular in nature, not cyclical. Keynesian economics talks about how you can, in a cyclical situation, right, a trough in an otherwise good economy, stimulate it with some cash or some government spending. Keynesian economics does not talk about printing money forever. And we've been essentially printing money since 2008, and actually we printed money in the early 2000s too. And we've been taking on debt since 1981. So now we have more debt than we did in World War II, and it's actually by a lot, because you should consider what's on the Federal Reserve balance sheet, federal debt. It's not independent of the government. Somebody's going to have to take that on, right? So what happens when the government says, we really can't do much more monetarily because all it'll do is cause inflation during a slow growth period? What do you call that? What do you call inflation during a slower no growth period when there's high unemployment? That's stagflation. How many of you remember the late 70s in 1980, 1981? I do. I was a kid. I remember bologna sandwiches. Luckily, we have more food than we know what to do with, although we're horrible at moving it around. So when you take a look at things, you have to think about what's going on. And if we choose in 6 weeks to continue with a low tax, low regulation of the financial system, top-down money pouring monetary approach, things are going to get really bad. And on top of that, we just have the uncertainty of a potentially close election that's contested. In that environment, how much risk do you want to take? Right? In 1981, the middle class started getting destroyed. A lot of what went on in that time period actually didn't have anything to do with Carter or Ford. It had to do with the Middle East. Deja vu. Now the Middle East is just going to destroy all the oil companies, because why would they hold back on oil production? They just told us that they wouldn't. So when shale is destroyed and deep water is in trouble, when the Saudi Arabians and OPEC, Iran, are telling us, hey, we need this money. We're not going to do anything to help your oil companies. What does that mean for America? There's only a couple different ways that plays out. None of them are good if we aren't making massive moves towards alternative energy and EVs. In one situation in 6 weeks, we would choose to poo-poo those ideas. And although industry is doing a good job of pushing us along, despite the administration, there is only so much that they can do on their own. In order to fix the economy, the government has to do a massive rebuild of the economy, or a massive rebuild of infrastructure, and a massive shift to an electrified economy. And if we don't take climate change seriously, we're going to see more and more of what's happening out west in the rest of the country. That's why I keep telling you, buy Great Lakes real estate. If you're not seriously thinking about buying Great Lakes real estate, then you're just not understanding the complete and overwhelming issues with climate change. The Pentagon has talked about this for 20 years now as the biggest threat to the United States. The Pentagon. Look up the quadrennial reports. The Pentagon has been telling us that climate change is the biggest threat to the United States. Destroyed crops, massive migrations, destroyed coastal areas. It's a big problem. And we're going to have to fight it one way or another. You're going to have to decide how you want to do that. As an investor, you have to ask, how do I get in on what's going to make that money? Because there's going to be a lot of money made. And largely that's what the barbell approach is about, because we want to be in the growth stocks and the growth sectors. And we also want the backdoor plays. We want to take advantage of the fact that we know that it's inflationary policy that they're going to use to fight everything. Maybe fiscal, maybe monetary, maybe both. A lot of the tech stocks and alternative energy stocks are bid up already. But copper and zinc and some of the metals, they're only up a little bit. So we have to weigh where we put a couple bucks. So from week to week here, we're going to take a look at the plug and play lists and try to figure out where we can make the most money. And here I want to talk about that chip on my shoulder and then some philosophy and what I'm not going to give in on anymore. I don't care how you invest. I'm telling you how I do it, and I'm telling you that it's right, because I stole it from some really rich people. You need a few ETFs to focus on the best stuff. You need between 12 and 30 stocks that are potential home runs. Your dividend stocks, you should still be looking at as if they can double and triple in total value, total return over 5, 6, 7 years. If you don't think a stock that you're buying with a dividend can give you a triple in total return in 5, 6, 7 years, not any more than 7, but 5 is better, but 5 to 7 years, you shouldn't be buying it. Period. All that middle of the market crap, you got to get rid of it. The zombies are going to get crushed over the next 5 years. And when they get to the point that they have to deal with the debt, right, because they got an extension, the Federal Reserve or the Treasury or Social Security or whoever owns that debt at the time is going to be asked, would you take equity back instead of money? Think about Occidental Petroleum. They're supposed to be paying Warren Buffett a big cash dividend. What have they been paying him instead? Shares. Massive dilution at Occidental. That's why I'm shorting them. They're going to $1. They might go to 0. You're going to have over 100 and probably closer to 200 companies that are faced in the next 5 years with what to do with all that debt. Is the government just going to keep rolling it over? So that they can keep employing people? Maybe. But how is that good for the shareholder? There's an awful lot of stocks out there that aren't going to go up in the next 10 years. And there's a lot of stocks that are going to drop 50, 60, 70, 80, 90, 99, 100%. I think Exxon is one of them. I think Exxon falls 70, 80% from here. They're already down 50. That's right. I think Exxon's going to end up at $10 a share. It's going to be about an 80%, 90% drop off their high, right? Why wouldn't they? They don't have assets that anybody wants. Oil is peaking. We're getting news from OPEC. Oil demand is not rising. British Petroleum telling us peak oil is this decade. Peak oil demand is this decade, and it might have happened last year. That's BP. BP is telling us that. So I want people to wrap their heads around the economic realities that are out there. And if you believe that what we've been doing for the last 3.5 years and what we did under George W. Bush is the right way to do things, then you're going to vote for Donald Trump. And may God have mercy on your pocketbook if you do that. Now, you can argue with me about anything else you want to argue about. Well, I like him for this, I like him for that, I like him for the other thing. Whatever, I don't care. I'm just telling you that if we go the path of more of the same, we're in big trouble. So that's why I'm not real aggressive with buying stocks. I have the list here, right? Very easy to take stock rover. And I'll show this to you every week. I don't care if you subscribe or not. These are the stocks in the growth portion of the plug and play. Dynavax I'm removing because they're too speculative. There you go, just did it. I don't know who's going to replace them. And I'm probably going to replace one or two others. Look at how high these stocks have gotten. So many of them closer to a 52-week high than low. There's almost nothing close to their 52-week low. Itron, and that's one of the stocks that I focused on today. I think that you can take a look at Itron real soon. This 0.5 line is probably where you can start buying it if you want to, if you feel good about the world, if you feel better about it than I do. But I'm probably going to wait till it gets under 50. I think 49, 48, 47, 46, right in there. It's probably where I want it. These guys help cities become more efficient with managing devices, their IoT stuff, their utility stuff, their lighting, everything. We've seen that they can rally hard, right? From 30 to 80. It's a pretty good rally in 2 years. From 50 to 85 in 6 months, 8 months, whatever that was. And cities aren't spending right now. So that's why they're getting beat up. Next year, cities and states are going to have to either A, declare bankruptcy so they can reset, or federal government's going to give them money. This is a unique opportunity to get into Itron because the cities that they do business with are short on cash right now. How low do they go? I have a hard time seeing them go under 45, but it's possible they could head all the way down to 30. In which case I would just buy more. So we will keep an eye on the momentum numbers and on your oscillators, and we'll try to figure out where they're going. Right now it looks lower. 45 to 50 looks like the buy area. Doesn't mean it can't go lower, and we have to keep an eye on that. If President Trump wins, I probably hold off and I look for a price in the 30s. If Joe Biden wins, I probably want it just under 50. So keep that in mind. AT&T is still calling, big fat dividend. Warner Brothers is worth something. You're watching the entire streaming world get bigger and bigger, and they're sitting on Warner Brothers. At some point, they sell that for a lot of money. And they're going to get a couple bucks for DirecTV too. Maybe half of what they paid for it, but it's still money today. Lam Research, one of the best companies in the world. It's not quite cheap enough for me, but I have created a buy zone here for you. I think right in there. It's tough to sell cash secured puts on this one because it's an expensive stock. So Lam Research, take a look at this. This line here, that confluence, I mean, in an Armageddon scenario, could it get under 200? It could. Man, that would be brutal. But if it did, at some point you got to hold your nose and buy it. It's that good of a company. And their dividend at that point would be huge as a relative percentage. Because at like 3% now, what happens if this goes down to 200? That's a 5% dividend. And then finally, I'm going to finish off with Kinder Morgan. I really need you to think about this in context. I've dropped the oil stuff. A lot of the natural gas, the reason natural gas prices were down is because there was a lot of affiliated natural gas produced when oil companies drilled oil. And that's been going away. And you've seen the price of natural gas go up. So your Anteros of the world, your Range Resources, whoever, they can pay their bills. They still have a ton of debt, and I don't think they're very good investments themselves, but they can pay their bills. And the biggest bill they have is the pipeline companies. So Kinder Morgan is sitting on all that revenue, contractual revenue. For companies, they can't renegotiate really. They're just going to they're going to pay their executives. They're going to try to get their stock prices up marginally. Kinder Morgan is kicking out an 8.5% dividend or whatever right now. Because people say, oh, it's fossil fuels. Well, kinda. It's a natural gas pipeline. And Warren Buffett just bought a natural gas pipeline for all the reasons that I've talked about. Natural gas ain't going anywhere. Oil and coal are. Coal first, then oil. Natural gas will be used until 2050 at least. And if the water problems are as severe as they appear to be, these guys already have right-of-ways for pipes. A lot of these pipes can already be converted for other uses, such as water. If anybody listening to me doesn't own Kinder Morgan, I have no idea why. The only reason can be is you just don't want anything to do with fossil fuels, and I can respect that. But if it has to do with value, if it has to do with the viability of the company, you're wrong. Warren Buffett dropped $10 billion on this sort of an asset for all the reasons I told you. So for a month, I've been telling you, buy Kinder Morgan. I hope you've done it. Analog devices. This is an example of a stock that's starting to become oversold on the daily chart, but not the weekly. So if you're a trader, you could trade up and down around here. If you're an investor, you want to wait till it's in the buy zone. And I think that this stock is strong enough, it ain't going to get much past the top of the buy zone. But you have to realize there's a whole nother level of support down here. It could actually get all the way down here. That line right there, I should probably trade this down. I mean, it could get all the way to 70. And that should actually be its bottom feeding price is 70, so I'll double check that. But ADI, we just wrote a piece about that. I think Dave did it. So keep an eye on analog devices. You're going to want to own this one. Options to talk about in here. There's really no option activity on Itron, so you really just have to look for a price. And then the oil hedges. I talked about oil a few minutes ago, and I'm just telling you, what's going on in oil is going to be another bloodbath because you have a lot of hardheads who don't understand that we're not going to be driving gasoline cars in 15 years. And we're not even going to be buying them in 7 or 8. So the demand for oil is going away, just even without the work from home economy. And then you put the work from home economy on top of that, and you have the potential loss of 6 or 7 million barrels a day of demand that's permanent. And that's what British Petroleum, BP, is talking about. There's a lot of oil demand that's not coming back. And the growth in the developing markets, the emerging markets, was almost all China, followed by India and then the rest of the world. But China is making a huge push into EVs because they see that as a way to generate employment. So if the United States stops selling ICE cars in 2026, largely, not all, but most of them are gone, and China's on the same path. You know, the transition is from 2026 to 2030 for almost all these countries. So you should consider what's going to happen to shale stocks. And while there are a handful of shale stocks that will survive, Pioneer being, I think, the best one, but I don't want to own it. I think you can short most of these down to about $1. Seriously, I think Continental, Occidental, and Devon are all going to about $1 in the next few years. Will they go bankrupt? Hard to know. Occidental's especially hard to know because of Icahn and Buffett being major shareholders. So I don't know how that'll play out. Continental Resources, you have Harold Hamm, who I'm sure would love to find a way to take it private. And to take it private, he'd probably have to cut a deal before bankruptcy. I don't think they'd let him buy it out of bankruptcy. And he's been selling his shares, right? So Harold Hamm, right, he's been selling his shares in Continental. Doesn't mean he doesn't want it. He just wants it after it becomes a cash flow play. And it won't be a cash flow play until you get rid of a whole bunch of debt. So there's going to have to be some sort of pre-packaged bankruptcy or something in a take-private deal. Devon Energy just spun off their Barnett Shale because that's natural gas. Kept their oil resources on one company, spun off their natural gas resources. I've told you about that. Man, I sound horrible. I told you that Exxon and other companies were going to have to split up. They would try to put their oil on one side and then everything else in other spots. The oil would be the one that died. So Devon is paying out $100 million special dividend when it has no business doing so. They have so much debt. They should get sued for it. But the shareholders aren't going to sue because they're getting $100 million, right? And management, they're doing all right too. Can you imagine management's doing all right too? So they're trying to say that they're going to buy back $1.5 billion shares, $1.5 billion worth of shares. They don't have the money to do that. Devon is in big trouble. And the management is acting the same way that Exxon's management is they're lying and cheating and bonusing themselves all the way to the very freaking end. And if you can't think of 10 different stories that end the same way, WorldCom, Enron, you're not thinking real hard. These companies are toast. So if you have it in you to try to hedge your portfolio, I think this is the easiest way to do it, is bet against the worst companies in the worst industry. Oil stocks. And all the knuckleheads in the chat, on the chat room, not our chat room, but the comment sections in the oil articles, all the people who have been telling me I'm wrong for 2 years about oil stocks, right? When I started talking about being priced for Armageddon, here's why, right? I mean, I was a long oil guy for a long time. I've been investing in oil stocks since 1999. It took me 3 ass whoopings to wake up. Oil's toast. And these companies are some of the worst. Occidental, I mean, I have no idea how that CEO is still employed. None at all. None at all. She should almost be in jail. And it turns out that Anadarko lied to him about the offshore assets. And those executives should go to jail too. These oil executives are so dirty, it's unbelievable. So back in this article, right, 5 months ago, or whatever April is now, I talked about how they were just flat out stealing. So now these companies are about to get crushed. Exxon, since I started talking about it, shorting it, is down $6, $7 a share. I'm not really sure. So I think that Exxon is interesting as a short because there's so many people holding on to it for the dividend that when that dividend gets cut, and I think it will either in the next quarter or the quarter after, stock plunges. And the puts are pretty cheap. Nobody wants to bet against Exxon, which is crap. It's just such a bad company. So I think Exxon is a good one to short. I think Occidental is a good one to short. think Continental's a really good one to short. Devon's a little harder to short just because of the option pricing, and you might have to pick a better spot, but you could do the basket for sure. Exxon, Continental, Occidental, I think are pretty easy shorts. I mean, I guess Warren Buffett could ride to the rescue and Carl Icahn would ride to the rescue for Occidental, but why would they do that? That's the only risk there, is they see more value in it. But I think that they're more likely to just take a post-bankruptcy stake. So these are either going to bankruptcy or close bankruptcy. Like I said, they're going to head to $1 or so. And after that, who knows? Who knows what the deals are at that point? Exxon, it's already heading down to 30. Talking about this a while. This one filled out the head and shoulders perfect, right? Fell off a cliff. Got it spike up to a 0.5 line, a 0 line, 1 line. I mean, that's a pretty good confluence there. Bounced off of it, head back down, almost back to the lows. So at about 33-ish, you got to ask yourself, you know, given that my options expire eventually, I might have to reset them. So when this gets down to 33, 34, you have to start having thoughts about time value, because you might get a little bounce here. So you might have to reset your clock. But ultimately, when they cut that dividend, long way down. Once it gets through here, it has a long way down. And at some point, they're going to have to talk about breaking up the company, just like Devon Energy just started to do, just like Dominion started to do. All these fossil fuel companies are starting to break up their companies. Exxon's not going to be any different. There will be some residual value to some of the parts of Exxon at some point. And we'll want to keep our eye on that. But the oil side of the company is in big trouble. And how they break it up, man, there's so many pieces, it's hard to know. They could do it on international lines. They could do it oil and gas. They could do all the above. Pipelines. I think they still have some gas stations. They have other real estate, office buildings. I mean, they have a lot to carve up. The problem is that if it's a fossil fuel resource, ain't nobody going to pay for it. So it's just a write-down. So when they write down most of their shale, other than the Permian, probably soon, and they find out, and I'm telling you, because I know people down in this part of the world, their wells in Guyana and Suriname are not going to be that great. They're going to be okay. They're not going to be great. You got to remember, Saudi Arabia and Iran and the rest of the OPEC, they're not going to do them any favors. They're not going to incentivize them to drill more expensive oil. They will find the equilibrium price of oil. And anybody above that price is done, out of business. All right. Tomorrow morning, we'll do some questions. Hopefully, I can talk a little bit better. I have a lot of editing to do here because I coughed a lot. Hopefully, by morning, I have one more good day. Fire up your questions in the Ask Me Anything chat over at Margin of Safety, or the Ask Me Anything forum over at Fundamental Trends. Other than that, I hope you have a nice night. I'm going to drink some more tea and start working on the editing here, which might take me a long time. Take care, everybody.